What's up, Outliers? Happy Friday. We are ready to get into some basics. So, the vision for this stream today is to talk a little bit about some of the decision making principles that commonly go into managing trades. And I want to deconstruct, as per usual, the good and the bad. It's very, very, very frequent that we will find instances of really poor inputs into deciding whether or not to manage a trade. As simple as that sounds, it sounds like, trading 101. But my guess is there's a lot of people out there that think they're managing their trade based on some sound inputs. And my suspicion is that a number of those actually are not doing a great job. And they're using inputs that don't necessarily matter quite as much as compared to other factors. So I want to spend a little time talking about that. And then we'll see how the conversation ebbs and flows. If there's anything as we go through that you have questions about or you want to dive into, as always, you are not interrupting. That's the point of doing these on a live stream, to have a ideally back and forth engagement to see if we can get to some of the nuance of these points. So great to see everybody. It looks like we got Lauren, Kirk, ZX. Everybody ready to get a little learning in on Friday. So first things first, I want to see if I can find a couple posts from Reddit, our favorite. Let me see. What I'm doing is I'm just reading like a couple posts. So like this one, I believe, is a good one. And for those wondering why I do this, it really isn't to like bother this group, or it's not to talk about the individual people in here. It really isn't. It's to talk about the concepts in here, because again, Reddit is such a really, really great place to think about what normal traders and what normal people do and how normal people apply these kinds of concepts. So I'm just literally grabbing a handful of these. We'll grab one more. Oh, this is another interesting one, more just because I'm curious how people responded to it. So first, let's start by creating a baseline, by seeing what quote unquote normal is and seeing what sticks out to us here. So we'll start with this one just because it's the latest one that went in here. This is from a while ago. It says, does anyone have a risk management strategy that really works? Meaning it provides consistent profitability for swing trading of long calls and puts and long and short vertical spreads. So as we go through pieces in here that stick out to me, before I tell you what sticks out to me, I want you to actively think about it on your side, right? This should be an active thought experiment for you, not a passive experiment, just because you'll get way more out of the experience if you're actively trying to synthesize alongside. So the first thing, though, that I notice is in this paragraph, which we'll circle back to, but in the meantime, think about what that might be. Then let's read the next. It says the prevailing wisdom, which I would characterize as swing for the fences, of starting to take profits at 100% gain while leaving runners if holding multiple contracts on long naked options, which that's not a thing, by the way, and debit spreads, or alternatively, when the short strike is hit for the latter, stopping out at a 50% loss and 90% gain / 100% loss on credit spreads, leads to low success rate for me and too many painful reversals and drawdowns. I know it should also depend on support and resistance levels, but assume those aren't hit or broken before the profit target or stop is hit. So really, this is cool because this person is going through kind of the first stages of taking a serious look at this. So in this one, there's 4 things that stick out to me. Next paragraph, I've seen some traders start taking profits on long options at as little as 20% profit while setting stops at breaks of intraday support or resistance, meaning their RTR isn't quantified, which doesn't make sense. On the other hand, if they were to set stops at 10% loss, that would result in being stopped out too many trades and could only work for day trading, as overnight gaps could result in losses much larger than 10%. So this one, I see three things. And then I've also seen someone who claims a high success rate and consistent profitability from a credit spread strategy that starts with taking profits at as little as 20%, although I'm not sure how they set their targets. Okay, let's deconstruct what's happening here. We'll start from the top. The first thing that I see here is this person's doing a good job when it says a risk management strategy that really works for swing trading of long calls and puts and long and short vertical spreads. And I know that sounds slightly backhanded, but it's not. This is a good starting question to begin for this person. The problem is they are trying to find something that works everywhere. And unfortunately, that's not how this works at all. That's not how trading works. So what this means is the way that you manage a long call versus a long put versus a long call vertical versus a long put vertical versus a short call vertical versus a short put vertical, right? All of these different kinds of structures have very, very, very different ways that management has to be integrated. Now, notice why I say integrated, because as usual, this is looking at the problem set slightly backwards. So what do you think I mean by that? Who can take a stab in the chat? Why I'm saying that? Why do I think that this process is backwards, specifically this section up here? Why is this backwards? Think about it in terms of actual application, and think about if you were to follow this kind of process, what kind of results would it yield? Your boy has a bomb Arnold Palmer. Love an Arnold Palmer. Who can guess? When we're looking at these different strategies, there's definitely structure implications. But if we were to make a base decision on management decisions in a trade, what's most important? You already know what's most important. Kirk says outcome-oriented, not process-oriented. That's a step in the right direction. It really is. That's moving in the correct direction. So that's good. So if we think of that idea that it's outcome of the individual trade versus the process that's being followed, that moves us a step closer. Bingo, Jordan has it. Profit mechanism. Here's the problem. If we're swing trading is a style. Inside this style of swing trading, there are many profit mechanisms. These different profit mechanisms likely require a different risk management approach. So even if we get rid of the fact that they're trying to have a risk management approach for all of these, that doesn't even start the conversation about within one of these, how many different potential takes there can be on managing the trade. And in this case, risk management. So how do we fix that? Well, this part's actually super simple. The way that we fix this is we literally apply something like the outlier strategy process. And as I always will remind you guys, you don't have to implement this exact thing. but you can absolutely use it as a benchmark. So in the outlier strategy process, there's a really important behavior that's happening between these two steps, the profit mechanism and then the behavior and signals. So this is kind of like the features. The reason why the feature matching is super, super important is because that inherently is going to inform your decision-making, period. Like that's exactly correct. So in this case, it says we're like using tools to measure and capture the profit mechanism, but we also want to identify PM features. So the things that ultimately matter, that's covered in signals, but to make it explicit here to not mislead anybody. So going back to this, when this trader is trying to deconstruct this, they have to start there. They should not start at swing trading, and they should not start by even worrying about what the structure is. They should start by defining the profit mechanism. So let's use an example. I like to learn through examples. I imagine many of you do as well. So let's say, well, first, before I was going to use one of my own examples, but what I want to do is actually ask ChatGPT, what are some common swing trading strategies, just so that I can get something that objectively falls within that bucket. So what are common swing trading strategies? Based on this, I just want to get a sense of how they're defining. So this is saying 2 to 15 trading days, which is pretty common, and that sounds about right. Trend following, mean reversion, momentum relative strength, pattern based, pairs rotation. Okay, yeah. So we can pick one of these and use it. Let's do the momentum relative strength. That's kind of an easy one. So I'm gonna use what ChatGPT is telling me, which is relative strength leaders on pullback. So set up top quartile 4 to 12 weeks relative strength versus sector market. Entry is first higher low after a breakout with relative volume at 1.3. It's invalidated if they lose the prior higher low. Okay. So let's just see if we can find something that exhibits a condition even similar to that. I'm just going to run through a couple stocks that have been moving. Yeah, this is fine. So we can use this. Let's find a spot in here where this would qualify, because this definitely was in not necessarily the top quartile, probably the top 20% or so. And we're looking for the first higher low after a breakout. So here we had a breakout, and then here's the first higher low. So let's say that there was an entry at this point here. Let me get rid of this madness. So it looks like there would be an entry at this point here, because it also has relative volume at 1.3, the like 5 and 20-day average. So in this kind of scenario, the way we choose to manage this trade has absolutely nothing to do with the value of the option. Absolutely nothing. The reason why that's the case in this scenario, using the swing trading example from that Reddit post, is what matters is what price does. Price for the underlying. What does not matter is what the value of your option is. And that's for a bunch of different reasons. For example, on this day here that we're pointing at on our entry, you could have made or lost money depending on when you got in and how the market moved post that entry. If you happen to hit, let's say, your 10% loss target, which is an arbitrary number that you chose to select, if you apply that 10% loss, you might arbitrarily get out of this because your option loses 10%, which is very common because options are levered, they move a lot. Even though based on your profit mechanism, it's still completely viable. It's still doing exactly what you originally set out and wanted it to do, which is to set up this breakout idea. So when we're thinking about risk management, this is the absolute most important component to keep in mind. Do not worry about what the value of your option is. Think about what the profit mechanism is, what then validates or invalidates the profit mechanism itself, not the value of your option. That doesn't matter. So let's take a look at the rest of their posts. And if you have any questions on that, please ask, because it's super important. So when we go to like these prevailing wisdom things, like this is the cliff notes for this. This is all fucking random shit. It's all completely random. None of it means anything. Literally nothing. If your option, let's say that your option showed a 50% loss, but it's because the underlying trended sideways and vol came down. If it didn't fall below, in this case, this higher low right here, let's say that you had like a 2-day confirmation rule or something. I'm just picking random shit. Or maybe you can say you entered here. It doesn't matter. Because really, based on the rules from ChatGPT, higher low is here. It would have been invalidated here. We would have gotten out. And then maybe we got in again here. Fine. So even though, let's say that you got in during the breakout up here, and even though over the course of these 3 days, your option might lose some set amount, depending on what option you picked and how you chose it, but it did not violate the higher low to the downside. So it's a perfect example of where if you apply these stupid arbitrary numbers to your option and get out at X% just because you've heard it somewhere, it sounds smart, this thing might have still completely qualified for the trade idea, not been invalidated, but just because we're applying an arbitrary management metric of an option value, you miss the subsequent move. Now, again, this is cherry picking, right? We're looking at a scenario in the past, but it's a really important corner to turn. The propensity is to base the decision heavily on the value of an option, which is a massive mistake. Okay, so I think that point's been elucidated. Again, if you have questions or want examples on that, please tell me. Okay, so we know what this is. Now, one of the things that I like is not this. Well, not this. Hold on. Where is it? Maybe it's up here. It said something about the frequency, and I wanted to highlight that. I just lost my spot. And by the way, like I said, long naked options isn't a thing. If you're long an option, you're not naked. You're literally covered. Whatever your long option was paid for, you've covered it with purchasing it. Okay. Yeah, this one right here. This sentence. So in this sentence, it says, on the other hand, if they were to set stops at 10% loss, that would result in being stopped out of too many trades. That's a great observation, a really good observation. Here's the problem. It's completely arbitrary. Again, completely arbitrary. There's an important concept that they're absolutely correctly navigating around. which is if you set a really, really tight stop loss, the probability of you getting filled and stopped out is high, naturally so. But this is also completely arbitrary, especially for swing trading of any kind, right? This is again why the profit mechanism matters so much. Because if we take the time to clearly articulate and define what the specific profit mechanism is that we're attempting to trade, then we can get more detailed in terms of how it behaves. Then you can apply generalized management principles based on that broader understanding of how the profit mechanism typically behaves. So, for example, I have a breakout profit mechanism that I trade quite a lot. In that approach, I have a very, very tight stop. I have a very high loss rate, over 50%. The majority of the trades are losers, but the losers are very small. And the smaller subset of winning trades is significantly larger, overwhelming the loser and the higher loser frequency. It's completely fine. It makes complete sense. But that decision on the stop is not based on the value of the option. The decision on the stop out point is whether or not price stops doing what is supposed to do. And I can give you literally a recent example of this exact thing. One sec, let me grab my log. Enphase. So I had entered a long trade on the 22nd here during this breakout. I literally exited the trade the next day on this close towards the end of the day. Why? Because in terms of price, it went the wrong way. So that becomes a super simple exit point. It had nothing to do with what the value of the option was. And in case you're wondering, it was down 17%, the value of the option. I had no idea. I calculated after the fact because I don't know. That management decision is based on the performance of the underlying against the profit mechanism. It is nothing to do with what the value of the option was at that point. Recess for a breakout style. Do you start with a small position and add if it's working, or full size generally on entry? It's a really good question. In general, I'm going to start with what I want, but that doesn't mean that I won't add more. It's definitely not like the covered strangles that you see me trade a lot, or even long-term ratio call diagonals. Those kinds of things are almost always going to be sized with room for scaling, because it's a really, really important part of the management of those kinds of strategies. In something like this, it's not. And again, it's because in this kind of scenario, when I enter here and I'm effectively setting my stop at a close below this, I'm sizing my exit so that whatever that loss is makes sense for the portfolio at this point where I would be getting out. So what that means is I might model what the loss would be at the 38 handle. And I effectively then figure out what the size of the position can be based on this loss point. So say, for example, in this kind of thing, it gets a very small amount of the portfolio because it's really a high probability of loss. So let's say it gets 0.5% of total portfolio risk. That means when this gets stopped out, then it might draw down the portfolio, the entire portfolio, by 0.5%, that kind of thing. But it's sized at that point with that in mind. Now, if this thing starts exploding up and it reconstitutes another potential entry criteria, that gets done again, but it gets done again in a standalone concept. So what that means is I don't really care that this went up to here. and the trade is printing some sort of profit here. Doesn't matter. What matters is if it looks good for another entry based on that criteria, I'm going to set up that new trade based on this exact criteria. So then this would get a stop up at this level, just like this had a stop down here. And then the management for both of those positions, even though they're in the same underlying, is slightly different. Echo says, I can't wrap my head around scaling options that are affected by volatility at time. Would that not change everything? Could you expand a little bit more? When you say change everything, why? Lauren says, I know where my stop is, but I'm not sure how to calculate my options to that stop. You mean what the P&L of your option would be at that stop? That kind of thing? Because if so, there's actually two really easy ways to do it. So for Lauren, that I assume that's what you're saying, but I want to be sure. Yeah, okay. So there's two ways. The first way is, well, I guess, Lauren, what platform do you use to trade on? Do you use are you on Thinkorswim like this, or are you on another platform? Because part of it will be platform-based. Jockstrap Mishap, that is an epic name. Lauren says Webull. I know nothing about Webull. Let me ask ChatGPT really quick. Does Webull show P&L diagrams for an option position similar to TOS? Simulate P&L at different price points. Let's see. So I really don't know much about Webull. It ain't something that I really use. Let's see. Because then if it doesn't, then we'll do the manual method, which isn't difficult. Jesus. Normally ChatGPT is pretty quick, but it's thinking pretty hard. Okay, so it doesn't offer. Yeah, okay, cool. So it has an option price calculator, which is good. Yeah, okay. So let me see. What the hell? That's kind of nuts. That's funny. So take a look at this. Webull literally diverts people to bar chart to use their P&L graph, which is kind of hilarious. So anyways, that hilarity aside, let's take a look at an example in here. So let's say that I wanted to go long end phase, and let's say that I was going to set a stop at 35.25, right? I'm just picking a number. So let's go in here and let's find an option that we want. We'll just do an at the money, 84 days out. And we want to see what our loss would be at 35.25. So 35.25 is here. It would be down $62. So this is the simple way, right? And again, like most actual platforms will do this kind of thing. So this IBKR, those do this. And again, they should, because this is basic. If you have a platform that doesn't do this, that's okay. You can literally make a Black-Scholes calculator in Google Sheets that does it for you. based on different price inputs. So that one is slightly longer of an exercise. So I don't want to spend a ton of time on it, but I'll show you an example. And then during one of our skill development segments, if we want, we can dive in a little deeper. But let me grab this. Yeah, okay, so this stuff is fine. I just got to find a space. That will do. So you can literally build a calculator like this. And the way that this calculator is built is I can effectively model, and this is actually quite accurate. I can effectively model different price movements in the underlying and also different Greek movements in the underlying based on these conditions. So this is super, super useful for developing a better intuitive understanding of options. So let's say, for example, let's use this trade that we're looking at. So today is 26 SEP. Spot price is 36.50. We're going to do a one lot at, I think it was 84 days to expiration. The IV, and this is to be able to get all the specific details. Like you don't need this just for a price change necessarily. This is just going to deconstruct the other movements. But the IV for the option itself is 76.44. The delta is 0.483. Gamma is 0.030. Vega is 0.07. And then theta is negative 0.03. So what I can do is effectively take these conditions. I'm just going to duplicate them in here first. And I can simulate the passage of time. So let's say that we simulate the passage of a day. Our day in trade is now $1. So I can see what will happen to my option based on these inputs, right? So if ceteris paribus, everything else remains the same, I can clearly see what my theta P&L attribution is. And all I'm doing is I'm calculating different metrics like my dollar delta, dollar gamma, position weighted gamma, different percent moves based on delta gamma. And then I can interpolate delta gamma theta vega. Now, one thing to note about the interpolations that I use here, especially in this calculator, this is just for simplicity. So I'm using linear assumptions, just taking the difference between two points and then assuming a linear slope. It's not accurate. It'll get you to the correct answer, but the path that it takes to get there isn't exactly correct. But this is something that we can do, Lauren, if you want, on the next skill development segment next Thursday. If you want, we can literally build this. It's already built, but it doesn't take long to build it. It's super easy. But anyways, with that said, I can then say, well, what will my option, if I'm going to get out at 35.25, what will my option look like? Well, I can see really, really simply what my option will look like. And it's literally from these exact parameters. Now, if you're wondering the difference between contract P&L and position P&L, that's a slightly different story. And it's just because I want to be able to extrapolate out for multi-lot positions. But the cool part is you can you can see that I literally don't even have the premium for the option in here because it literally doesn't matter. It's being calculated in the back based on the inputs. Now, again, another assumption that I'm making here is a base risk-free rate and stuff like that. So this is really just to simplify and make things a little easier to analyze, but literally this is it. So you can build something like this where you can tinker with changes in price and volatility. And then you can see what your option would be worth at these different points. Super, super simple. Great question. Okay. There was a couple more. Echo says, I mean, T1 time volatility dictates a certain P&L graph, but T2 time after maybe a news move, how does one adjust options at that point, or do you simply abandon it? Okay, yeah, I see what you mean. So, and it's a good point, right? Funny enough, that's actually one of the things that building a calculator, which again, everybody can do this. It's super easy, but that's one of the benefits of building a calculator like this is you can make different inferences based on what the premium of your option will look like based on changes in vol as you're describing. But if there is some sort of big change in your vol, but that isn't a primary component of your trade position, it doesn't really matter. And the reason why it doesn't really matter is because if the profit mechanism itself is still alive, then the profit mechanism itself is still alive. Now, with that being said, if you're trading long options and you know that you're going to hold through an event or something like that, you absolutely should integrate at least an interpolated change in vol. So for example, let's take a look at Enphase, literally just because we're on it. And if I take a look at vol, I can literally ballpark what the volume of my option might change by literally just looking at the recent history. So I can see from this peak to trough, that's 75% down to 69%. I can see a bigger move from here, 69% to 62.7%, right? So I can easily see, okay, this is what, a 6.3% change or 6.3 point change in vol. That now becomes part of my mental calculus. So then I can go to that calculator and I can say, if vol changes by this amount, how much will my option change? So in this case, if we have vol priced out at 76, let's say vol goes to 69 and we get that contraction, I can now see what my Vega P&L is resulting from this. And I can bake that into the sizing of my position. It's a good question. Echo, let me know if that answers your question. Daniel says, I was wondering which playlist is best to start for a noob out of all your playlists. There's two of them that I would suggest. The first one for sure is the 101, which I can grab for you, this one. And this one is options. Well, I guess there's three. This one is options 101. If you're a complete beginner and like you're still learning about like the basics of investing and stuff like that, then this video is for you. This one is investing 101. And then this is the playlist that I literally think anybody that watches the channel really should spend some time in, which is the outlier trading concepts playlist. That's where we get to some of the nuances about the way that like I think about markets, the way that I think about trading, and more of the nuanced stuff will be in there. All right, ZXborg says, do you stop out with the GTC limit order on the option or use an alert on the underlying monitor by hand? Yeah, I effectively never use a resting order. And it's literally because options can move a lot. So I have a video actually on using stops in options trading. So who asked that? ZXborg. ZXborg, that video I just dropped is for you, which is about using stops. But in general, if I am able to be at the screen and look, I'm just going to set an alert on the underlying, and then I will physically enter the order. There are a lot of periods throughout my trading career, especially while I was on active duty in the Marine Corps, where it's just not realistic. In those instances, I have to enter typically stop limits, sometimes stop markets, which are awful, but it's got to be done. More often than not, if it's a really important trade, it's going to be a stop market, and I just accept the fact that I'm going to get my face ripped off in terms of the fill, but it is what it is. the reason for that is, like, as I was describing, the value of an option literally can change massively simply in the course of a day. And it might not even be anything bad. It might not be like something catastrophic is going on. It literally can just be the way that that option happens to be behaving at that point, which is a good question. Echo says, I've been doing that using a tool that allows adjusting vol and seeing how the strategy reacts, but it's paid and limited. So I am doing as you say and writing my own. Yeah, you can definitely write your own. Like I said, it genuinely is not difficult. So for those that are in like the Patreon, the pro side, we have a skill development segment every Thursday. So that's what we'll do next Thursday is we'll just sit down and build this together. But if you don't have access to that, that's totally cool. You can essentially take what's on the screen here and use it as inspiration to then just vibe code it or vibe ChatGPT it to get to, what you think it is. What I would highly recommend is make sure you use the same inputs that I have here so that you can at least see that yours is calculating properly. Because if you don't know what you're doing, then it's really difficult to like validate if it's right or wrong. So literally just use this. And yeah, for sure. It's 100% easy to do your own. And the other one on Webull said that Bar Chart has one. Maybe that's free. I don't know. Let's see. So options. I have an affiliate relationship with them. So I don't know. Let's see. I'm going to drop it in a private browser. So I want to see if the tool is available. Yeah, you literally can use the tool from Bar Chart. So this is on a private browser, so I'm not logged in or anything. And yeah, it literally has the option data for you. And then you can literally change the price. It's perfect. It's literally perfect. I love this. This is good. Yeah. So you literally have a completely free tool here, which is sick. Super cool. Yeah. And then what we'll do on Thursdays, we'll build this out to be the rest of like a Black-Scholes Merton calculator, because really you just need a couple more inputs. You just need to actually explicitly state the risk-free rate and any corresponding dividend, which is, again, super easy to do. Okay. My favorite entries are when IV is down 30, when IV 30 is down and the underlying is down. If I'm bullish in IV 30 down and underlying up when entering a put position. I mean, that is a thing you can do for sure. All right. And then, okay, so we can kill this one. And let's take a look at maybe one or two more of these. This one I'm interested in, managing deep in the money short puts. I have a general strategy question. Sold puts a couple weeks ago. Things ran sideways. Yesterday, stock took a dove deep in the money. Expiration this Friday. Okay with owning the stock, but I hate for my cost basis to be so much higher that I won't be able to wheel the stock to get back out of it. So the funny thing here is for this person, it's literally backwards, right? They're saying, I'm okay with owning the stock, but I hate for anything related to actually owning the stock, right? Like it literally is entirely backwards, which this is really, really common where people want to say something and that to be their reality, but it really isn't. Like that's just not how it goes. So in their minds, they're aspirationally wanting to be okay with assignment, but as you could tell, they're literally not. All right. So one of the issues with their decision cycle that I can clearly tell is they're building the plane as it's flying, right? The trade is on already. The situations are developing. You're not always going to have a discrete answer for everything. However, you should at least give it a genuine effort to plan through most scenarios to see if you can at least rough out how you will think about and how you will behave. And again, an important component to this is to genuinely put yourself in the scenario of whatever is happening. So for example, when this person sold the short put, it's very, very clear that they did not genuinely put themselves in the scenario of taking assignment of that short put. How do I know this? Because they literally say this. If they were okay with assignment, they would have sold that short put at a point where they wouldn't hate their cost basis change based on getting it at that price, right? So this is a prime example of somebody who didn't do that. They just kind of applied some sort of half-hearted approach, and now they're figuring it out. So that's one super important thing, is to actually go through the exercise of thinking of how you intend to manage your position based on different situations before they occur. It's really important to do that because, one, it gives you planning practice. Two, it allows you to actually conceptualize the scenarios and have a game plan in the event that they occur. Three, it is a starting point for other decisions if something unexpected happens, which does frequently happen. So we do this in the military all the time, and I give this example frequently because it's super important. The main thing is when we're planning these really large-scale military operations, for example, an invasion plan or something like that, we're coming up and creating the best possible plan that we can given what we know at that point in time. There's no part of any actual military planner that actually believes whatever was drawn up is actually what is going to happen end to end. It's just not how it works. This is why in the Marine Corps, we have a thing called commander's intent. The purpose of commander's intent is acknowledging this exact fact, the fact that shit is likely going to go sideways. And this big, awesome, beautiful plan that we made together is great, awesome to have, but shit is likely going to go sideways and you're going to have to call some audibles. The purpose of the commander's intent is as you are calling those audibles, you call them so that they, at the very least, align and push you further to completing that commander's intent. So putting that into trading context, at the beginning for this person's short put, they should have had an effective commander's intent for that short put. Is it to manage the short put as a short put and not be assigned, which is what this is? Or is it to just use it to acquire the stock, which this is not? But doing that before you're in the trade is important. So that is my last cliff notes on that. GME says, holding options with at least a couple months can allow me to DCA until it trails above my average. Black-Scholes help. Yeah. I honestly think that you probably need to rough that out more because that general flow honestly doesn't make a ton of sense by itself. And I'm not saying that to like trash your idea. If it works for you, it works for you. I'm only saying that based on my conscience, which is saying like based on what I'm reading there, you should at least know that there are definitely some holes in that and some red flags that pop up even in the way that it's framed. So yeah, just make sure that you do your due diligence and you research the profit mechanism and, you know, that kind of fun stuff. Anything else you guys want to hit before your boy bounces? I got time for like maybe one more. Cool. All right, gang. Then that wraps me up. If you guys need anything, let me know. Be an outlier. See you guys later.